Welcome to the EY NextWave Private Equity Podcast, where we explore what's happening now, next, and beyond in the world of PE. Digital, sector, talent, value creation, ESG. These topics are top of mind for executives across the global private equity ecosystem. Join us for the insights you need to reframe the future of private equity. Now, here's your host, Winna Brown from EY.
Today, we're joined by two EY specialists on global tax, Jennifer Shearer and Alexander Reiter. Jennifer is based in the US and Alex is based in Germany and leads our European private equity tax team. Thank you both for joining us today.
It's a pleasure to be here.
Clearly, these are interesting times that we're living in. And from my discussions with PE fund leaders and portfolio companies, I know there's been an immediate and urgent focus on analyzing the financial health of individual portfolio companies and their respective ability to weather the economic impact that COVID-19 is having. Are you able to share how you're seeing how private equity leaders are tackling this challenge?
Sure. Especially on the short term, all of the private equity clients are focusing on liquidity and build task force to analyze the impact for their portfolio companies. And as I mentioned, liquidity is key, which means that all people we see in the market are drawing all of their credit lines. This is right for the US, but also for Europe. And a lot of banks around the world are supporting this. Nevertheless, there are also some sectors where we see some issues in this regard because banks are refusing to provide additional loans. And tax can support this liquidity measures because governments around the world are setting programs to support liquidity because countries have identified that liquidity is in the current crisis key. That is in particular cash tax deferral programs where payments can be postponed or prepayments which have to be made around the world on a monthly or a quarterly basis can be reduced. The next focus is really state aid programs, which are basically in most countries, beside any kind of incentives, loan programs, which again supporting the liquidity. In addition to this, the employee aspects, especially around to deal with salaries which have to be paid, also revenues may not come in, are very relevant. And the focus is here especially on reduced working hour compensations which are available around the world.
As you've highlighted, Alex, a critical part of this analysis has been for companies to really understand the various government aid programs that are available to portfolio companies, both in the US and importantly, globally. Are you able to give us a little bit more of a flavor of some of the measures countries in EMEA are putting in place that portfolio companies can access in the short term?
Yes, and for Europe also the programs are very country specific, which means that each country set up different programs and accessibility requires different applications and also different types of programs. However, I think what we are seeing on the cash tax deferral programs, all of these programs are in the focus to defer tax payments. The only difference between the countries is basically the question how long it could be deferred, so 3, 6 or 9 months or even to next year, and which taxes are covered. So we see that definitely in some countries only CIT is in the scope, but in other countries VAT, wage tax and also social security contributions and custom duties are able to be postponed. On the state aid programs is really a difference between small and mid-sized companies because for these companies really incentives and state aid is available in some countries, but for the larger companies, which is true for most of the PE portfolios company, it's not really state aid, but it's rather guarantees for loans granted by the banks. And the difference again between the countries is how much of the loan is then from a risk perspective covered by the government, which goes in Europe between 70 and 90%. And also about whether it's only liquidity which is required due to the COVID crisis, or In addition, what is also needed to get this is especially the questions around whether the companies have a business model going forward. And that is one of the critical parts in the current application process with the banks, because they retain a certain risk. And for this background, the companies want really to understand whether the requirements of this government guarantee is fulfilled, and the company would be able to repay the loans because they are on the hook for a certain amount of risk, and the company has a business model going forward. In many countries, there is really this reduced working hour compensation and other measures available to reduce the liquidity outflow from salaries to the employees, especially for such companies which are currently, due to the lockdown, not able to generate any revenues.
Oh, there's a lot there that's on offer in Europe. Jennifer, what about the U.S.? The CARES Act got approved on Friday night. Are you able to share some of the key elements of this package that companies in the U.S. can access?
Sure, and keeping in mind that this is the third round of stimulus that Congress has actually provided, and there's certainly an expectation that round number 4 is coming, although I think Congress is going to wait to see exactly how this CARES Act is impactful for businesses. But some of the key elements in what we've gotten are, first of all, government loans for a lot of the distressed industries. Obviously, the airlines are suffering, hospitals, transit, states. The keys, though, on those government loans is that they come with strings attached. And this is coming from really lessons learned by Congress as part of the Great Recession in 2008, where we saw a lot of stock buybacks and executive compensation bumps. And so there are limitations on whether there can be stock buybacks or increases in executive compensation post people taking these kinds of loans. In addition, there are small business loans of up to $10 million. They're based on, it's not, you can't just immediately get $10 million. It's based on a math around your payroll spend. Those loans actually can ultimately turn into grants and be forgiven in certain circumstances. And so those might have some pretty good opportunities there. But you have to have under 500 employees in that situation. So again, it may or may not be beneficial for a lot of portfolios. There are also tax credits that are being provided for just keeping people on the payroll, even if a business is shut down or has significant losses in revenue. But if you take those credits, then you have to pick between the credits and the small business loans. So that'll have to be something that's considered if you're trying to take advantage of one or the other opportunity. One of the big, I'd say, gifts that people are seeing, and Alex had sort of alluded to this as well in Europe, is that Congress has provided a deferral of the employer portion of the Social Security payments for 2020. So that's the 6.2% employer tax on the first $130,000 or so of compensation for each employee. Those payments will be due, if you take advantage of this, 50% at the end of 21 and 50% at the end of 22. So that actually is real immediate cash tax savings for a lot of companies. In addition, there are some income tax benefits. So a lot of people are familiar with a 30% EBITDA limitation on interest deductions. That's been increased to 50% for 2019 and 2020, which will be very helpful for a lot of companies who are at least taxpayers. And then also the Tax Cut and Jobs Act of 2017 removed the ability to use net operating loss carrybacks. That has actually been suspended, so you can now carry back NOLs for 2018 through 2020, back 5 years, so there's an opportunity there. Although I would caution folks to really take advantage of doing modeling on those NOL carrybacks, because you could disturb tax positions in those prior periods that might be not as advantageous as you would think.
So Jennifer, we spoke a lot about the CARES Act and the provisions that it provides, but within the U.S., there's obviously a whole number of states that are enacting their own policies and their own plans. Can you give us a little bit of flavor of that?
Sure. It starts at the federal level, amusingly enough, because a lot of states just whole cloth adopt the Internal Revenue Code as part of their own taxation code. But a lot of states don't, or other states can actually pick and choose which components they actually choose to use. So you have to go state by state to determine what portions of the CARES Act will actually be applicable in any of the states that you're operating in. But in addition, a lot of the states are trying to do their own thing and helping out. So we know that I mentioned that the federal government is allowing folks to defer their estimated tax payments, their extension payments with respect to 19, but we also have a number of states that are doing that as well. Not all states, so you have to go again state by state, and that seems to depend on how far along the states are with their COVID-19 response. So for example, California was an early adopter of the deferrals for estimated payments. Another area is also sales tax abatement, or not abatement, but at least deferrals of payments. So you really have to kind of look in every state that you're in, especially if you're in a significant state, to see if there are special provisions that are being provided locally.
So there's a lot of detail and a lot of nuance for companies and private equity owners to really understand before they jump in and take some of the aid that is available. For example, I've been hearing that in the U.S., many portfolio companies may not actually be eligible for the small business loans as they're considered an affiliate of their broader PE fund. I know that's a question that many private equity funds are still looking into. Alex, are you seeing similar examples in Europe where there's no free money, right? So there's
Yes.
a lot of different programs, but you really need to understand the detail before you jump in. Can you give us a flavor of that?
Yes, and then as you mentioned, I think also in most of the European countries, there is not like this affiliated concept like in the US, which means that PE portfolio companies can apply for such a loan on a standalone basis. But however, what would have to be really the key gating point to get this in a European market is we have to see that it's really country by country, and the loans are always foreseen that they support, let's say, the local business, and many of the portfolio companies are not like operating only in one country, but rather operating across Europe in many countries. So you have to see how to manage this to get loans in different countries, and you have not to forget that you have to deal with the existing lenders, because the question is what is a basket, what is allowed to lend in addition to the existing financing, because a lot of PE portfolio companies are highly leveraged, and what waiver you need from the existing lenders to access these loan programs. And again, there could be some issues with, let's say, with the banks to get access to these loans, could come from the fact that a lot of companies are already over-levered, and you have to deal with it that maybe some of the PE portfolio companies are more levered than the rest of the corporate market, which is currently also applying for the loans. And we will have to see over the next weeks how successful private equity portfolios are to get access to such loan programs. The alternative is always to get additional loans either from the existing financing parties or also from the sponsor, because then you are not limited in what you are doing after the crisis, because all of these loans always goes with some restrictions, especially around when you have to repay it or how many employees you have to retain in the respective country. So it has to be evaluated, and it's important to do this on a coordinated approach, especially if the PE portfolio is not only operating in one country.
Yeah, and I guess there's a sense of urgency right now because everyone is trying to scramble and work out what all the different programs mean and what they offer, and they all want to make sure that their businesses have the best chance of making it through the economic disruption, and obviously want to take care of their employees. But before jumping in there, to your point, they need to really understand the implications. Do both of you have some advice as to what you think portfolio companies and PE leaders should be doing before they jump in and enter some of these arrangements so that they're really going in there with their eyes wide open?
Yeah, from my perspective, it's important to have a concept to do this. So to be it coordinated and analyze it from the top. So either on a PE portfolio basis, so for each PE portfolio company, or like for a number of PE portfolios in a country or in a region, and see like to check what programs are available and which programs might be the best outcome. And my advice would always be, especially especially if it's loan programs, to consult always with your existing financing parties, because without them you can do basically not request this. And that would all take time. And as you mentioned, timing is key. And so my experience here is to get really these loans will be a process which takes in Europe at least 4 to 6 weeks.
And Jennifer, any thoughts about the US?
Yeah, in the US, I think we're seeing similar things where there needs to be a coordinated effort. We are seeing that a lot of the PE houses, the deal professionals are basically no longer spending a lot of time looking at additional investments, ways to use their money with their LPs, but instead are really shoring up the existing portfolios. And those deal professionals can work with their credit teams, et cetera, to make sure that there's a seamless analysis, and they apply kind of a similar thought process across the entire PE complex. That tends to really help because people get really smart really fast, and each of the portfolios can take advantage of that experience that the executives are using across the entire complex.
So we've covered a number of short-term measures that companies need to consider to address the immediate concerns that they have around the impact COVID-19 is having on their companies. What are some examples of the medium-term actions that companies are either starting to take right now or are considering taking?
So in the United States, I think one of the big things that a lot of people are talking about are debt buybacks, especially if you have a reasonably healthy company, but because of just how the entire system has sort of blown up, their debt might be trading at a significant discount. And this is a great opportunity then to take advantage of bringing some of that debt back into the company and basically retiring it. The trouble with that, though, is that if the portfolio itself buys back its own debt, it's highly likely that creates cancellation of indebtedness income. And unless the portfolio is insolvent or in bankruptcy, that COD is going to be considered taxable. And so a lot of companies are spending time thinking about ways to buy back that debt, not necessarily directly into the portfolio itself, but within the broader PE complex in ways that do not trigger those cancellation of indebtedness income problems. The structures to do that are varied based on either the portfolio's own ownership, so if you have just one PE owning the entire company, or if you have co-investors in the system, or we also have to look at the mix of the PE's own limited partners. Do you have a lot of foreign investors? Do you have a lot of domestic investors? Those kind of issues have to be taken into account as you think about how to build a structure to actually buy back that debt without triggering the COD.
And in Europe, in addition, it's important. I think this cancellation of debt income is likely mainly in the US, but in Europe, it has to be carefully structured. And as there are structures available to avoid at least the immediate income, which is taxable. However, the structures have been changed over the years, and especially if you compare it like to the structures used in the financial crisis, because we have, due to the BEPS initiatives, introduced anti-hybrid rules. And the consequences of this anti-hybrid rules, as well as at lender perspective, so the entity who is acquiring this loan, that this income is not sheltered by interest, because otherwise the 30% limitation, which is now implemented across Europe, is triggering in. So I think that's the key topics from a European perspective.
So really very important that companies take their time, really understand their structures, and understand the different steps they're going to take in order to either engage in debt buyback or use other measures as they move forward to help them in this time. Because rushing in sounds like they could actually do more damage than good.
Agreed.
Yeah, makes sense.
As we think ahead to beyond, the current crisis, we talked about short-term measures that obviously companies and PE complexes need to think about straight away. We talked about some of the medium-term measures that companies can implement and will need to start planning for. And I know sometimes it feels like we're never going to get to the other side of this, but what are some of the long-term drivers at the portfolio level that, will really need to be addressed as the portfolio companies come out the other side of this economic crisis?
The main topic from my perspective is really, and it's depending on the industry where the portfolio company is in, but clearly what we see here in Europe, it's really the broken supply chains, which means that especially if companies are in the production business and get not the supplies like from China or from other countries, because basically all borders are closed at the moment, which means that people have to think about how to fix the supply chains. They have to think about their sourcing concept, which means in the past it was really rather viewed as a global sourcing structure. And I think in many instances, people will rethink and about to have at least a second source, which is rather locally, to ensure that the supply chains are not broken again. And I think overall, this will be a catalyst for companies to think forward. And to fix all of the supply chains will be definitely then, if I think from now onwards, for the next 3-4 months, I think the key topic.
And Jennifer, anything additional from the US?
I think that broken supply chain point is really valuable. I mean, one of the things we're certainly hearing about are how global companies really embraced the just-in-time inventory management system. And that's obviously not worked out as well as they had hoped as part of this crisis. And so thinking through whether or not they need to have more supplies on hand will be very interesting to see what people do.
Clearly, supply chain is critical to the future and coming out on the other side. You know, there are changes to the way companies are working and dealing with their global supply chains that you think they need to perhaps rethink. What are some other lessons that, perhaps have been learned or can be learned through this crisis and ways that companies can protect themselves against future potential global disruptions?
From my perspective, really digitalization is a key word, because if you see the companies which maybe in the crisis now are more easily handle all of these aspects are really, if you see it like from a retail perspective, which are multi-channel. So having not only stores, but also like able to sell things about the internet. And so the entire process would lead to more digitalization. And again, if you combine it with the supply chain and assuming that more sourcing will happening again locally, where the labor costs are higher, there is, I would say, not an option not to digitize the processes, because otherwise the cost would be too high for local sourcing.
And I think some of the things that we're hearing, especially from my tech private equity clients, is really thinking about things that are just good corporate hygiene. So cybersecurity, making sure that you have enough bandwidth for your private networks to make sure that if your employees have to work from home, that your systems can actually handle that. Because you could find a situation where especially some of the portfolios conclude that they don't necessarily need everyone to be working in an office space, and actually taking advantage of people learning how to work from home, not necessarily needing as much real estate, things of that nature that might be kind of interesting to see what happens next.
That actually is a really interesting point. When we reflect on the time that we're going through today, it'll be interesting to see what changes that companies implement in the way that they do business, the way all of us do business as a result of having lived through this economic disruption and COVID-19. I'm sure it's going to manifest itself in many different ways that we'll only find out the true impact, if you will, of COVID-19 on our lives, on our business lives in the years to come. And some of that, I think, is probably going to be some really good business practices. Perhaps in some areas, such as supply chain or the slowness to adopt digitalization, it'll actually prompt companies to take a different view around business and perhaps adopt practices that will only make them stronger down the track. So Alex and Jennifer, thank you so much for joining us today. We really appreciate you sharing your insights, exploring some of the real ways that portfolio companies and PE complex leaders have been working through the challenges of the short-term impact of COVID-19 and the economic disruption, and exploring some of the medium and long-term areas that they'll need to explore and consider and adopt to address the impact of COVID-19 and get to the other side. So thank you again, both of you, for your time. It's really appreciated.
Sure.
Thank you.
Thanks for tuning in to the EY NextWave Private Equity Podcast. For more thought-leading perspectives and to get in touch with Winna Brown, visit ey.com/private equity. You can also follow us on Twitter at EY Private Equity. We'll see you on the next episode.